before we get started. One is this is a life science symposium. Okay, my name is JJ Richa with Pismo Ventures. Pismo Ventures is a venture firm, and also we help startups with their startup needs, from ideation to raising capital. We also help them raise capital and also invest in them. We've been around for about 5 years. We do 2 events a year. They've been virtual lately. One is life science, one is non-life science. The life science event usually runs in April. We pushed it a little bit this year, but it will probably go back to April starting next year. The non-life science event is usually in October. So just an update on that. This event, we had 155 companies apply from 27 states and 5 different countries, including the UK. I think Jeffrey was promoting it there. So out of the 155, we needed to select 10 to present to investors on Thursday this week. So it'll be it was really hard to select just 10 out of so many, but we have 10 companies that will be presenting at noon Pacific time in 2 days, June 15th. That's basically it as far as update. There is one more expert panel coming up right after this one. Please don't miss it. And it is more specifically as well about the roadmap for life science companies, as far as their roadmap to success when it comes to starting a life science company. This one is very specific to funding startups from seed to Series A. And Dr. Brian Coblitz will be moderating. He will introduce the rest of the panel. I will leave it up to you, Brian. I will be in the background. If you guys have any questions, please ask these questions in the Q&A section. And then we will have about an hour here. And then after that, there's about 15 minutes of Q&A time. But you can ask questions along the way as well. That's what Brian requested. Thank you very much, all. And Brian, take it away.
Thank you, JJ. Thank you very much for helping to put this event together. It's really fantastic to participate in presenting, and it's amazing that we're able to top last year's event this year with participation. Very excited to be a part of this, of bringing these educational webinars to such an incredible audience. My name is Brian Coblitz. I'm the Executive Director of Technology Commercialization at the George Washington University here in Washington, D.C. And our job is to take technologies from the lab at GW to the world. Primary way that we do that is by doing deals with startup companies and forming startup companies. And it's very important to us to make sure that they're able to get funding because that is a key ingredient to bring a technology from the early stage that we have to the marketplace. And that goes with the 2 other ingredients, which are the technology and the people that get the work done. So here we're really going to focus on that funding portion, which is so critical and often one of the most challenging parts to really get the startup ready to flourish. And I'm really excited that we have all bases covered today in terms of representatives from each side of the table, from early stage to later stage investors, as well as expert attorney who helps to negotiate and finalize these deals. So because they're such illustrious panelists, I wouldn't be able to do them justice with my introduction. So we're going to go one by one, and they will introduce themselves before we get down to some key questions and topics on startup funding. And we'll be happy to take questions and mix them in along the way. So I would like to start with Dr. Jeff Hausfeld. Can you please make a brief introduction?
Thank you, Brian, for inviting me. JJ, you as well. I am a retired surgeon. Did my training at Yale in otolaryngology, facial, plastic, and reconstructive surgery. Practiced in the Washington, D.C. area for about 23 years, then went back, got an M.B.A. at Johns Hopkins, a degree of organizational development at George Washington University, and switched careers from being a surgeon to being a full-time entrepreneur. My first foray is that I build and operate assisted living facilities for Alzheimer's and dementia care patients in the Midwest. My second entree is I am the chairman of the board and the chief medical officer of a biotech company in Maryland called BioFactura that specializes in biodefense and biosimilar assets.
Thank you, Jeff. Next, John Grant, can you make a brief introduction?
Yeah, hi, I'm John. I work as an independent advisor, consultant. I had a corporate career prior to that. My background was originally in science, physical chemistry. I later went to business school. I worked at 3M for about 30 years, initially in technology and product commercialization, later in business management. And I spent most of my career in strategy and mergers acquisitions. I had more of a knack for that. I probably, I don't know, spent maybe $3 billion on acquisitions in primarily US and Western Europe, some elsewhere. I did some divestitures and I did some corporate venture investments. And that's how I sort of got interested in this. In 2019, I ended my corporate career, took an offer to end it, and eventually got into strategy consulting, initially in startups. I do some emerging companies, and I help companies with fundraising, strategy and operations, and the exit. I can do fundraising and the exit. That's kind of valuable. I do some angel investing on the West Coast and in Minnesota. I'm primarily based in Minnesota and also in Southern California. That's a good weather balance, those two geographies. It's a pleasure to be on this panel. Thanks.
Thank you, John. And Dr. McKee, would you like to share your background?
Sure. Hi, everyone, and thank you for having me today. My name is Cynthia McKee. I'm a scientist by training, hence the PhD that follows my name. My graduate work was in molecular biology, epigenetics, that kind of stuff. Postgraduate, I went, or after graduation, I went to Amgen and worked in the licensing group for some time. And then I joined Amgen Ventures in November and am currently running all of their operations and managing the public portfolio.
Great. And so as you can see, we have the entrepreneur representative, angel investors, and venture or strategic investing. And last piece of the panel is Azad, who brings the attorney experience.
Yeah, hi. Thanks, Brian. Nice to be here. Nice to join the panel. I'm Azad Virk. I'm a corporate attorney down here in Southern California. I'm a shareholder with Stradling. It's a business law firm. My practice primarily focuses on emerging growth companies. I've worked with companies from from an early stage and taking them through various through their life cycle as they look towards an exit. I've focused primarily on corporate finance, fundraisings, and through various phases of fundraising to hopefully an exit. I also do a fair bit of technology transactions, and as part I being in Southern California, I get to work a lot with life science companies. So that's primarily my background.
Great, thanks. All right, so we're ready to kick off here. And as I mentioned, I have a few questions for the panelists to get us going, but you're welcome to add questions in the question and answer section or in the chats. First, I'd like to ask Jeff, as the entrepreneur, how do you determine how much funding your startup needs?
So that's always a very difficult question to answer. Let me first say that one of the reasons that I'm here is I represent the Society of Physician Entrepreneurs. This is a non-for-profit organization that I am a co-founder of and the chairman of. It has about 33,000 LinkedIn members throughout the world. And what we try to do is to teach physicians, healthcare providers, and life science professionals what are the opportunities and what are the obstacles to bringing your innovation to life. And we welcome you to join SOAP whenever you can look up www.soapnet.org. So Brian, your question is how much, right?
Exactly.
You always are asking, you always think that you're asking for too little. And the investor always thinks that you're asking for too much. So it's a difficult balance to try to say, how much do I really need? And what you have to think of is, what is your runway? How much do you burn on a monthly and yearly basis? Do you have any source of revenues? And if you don't, then you better get a lot of cash in when you can, because you're going to have a significant dilution no matter what you do if you have no other source of external revenues. So what you don't understand many times when you're raising money is that things fluctuate in the market. And if you have a good time in the market where cash is available and the market is not crashing and the geopolitical climate is good and you're able to raise funds, do it and raise as much as you can without upsetting the apple cart in terms of your existing investors and diluting them too much. So it's always a balance of dilution to your existing investors and your founders versus having enough runway to get you to the next milestone when you can go out to the market again, hopefully in good conditions.
Thank you, Jeff. Anybody else have any thoughts to add on how we determine how much the startup should go for? Nope. All right. So, anytime, as we go through the questions, if you have something to add, maybe you can give me a hands up or something. I'll make sure to hit you. But after that, I want to focus on some of the key factors from the other side of the table. So once the companies figured out how much they want to ask for, and then the investors start taking a look at whether they want to put the money in. So John, maybe you can share with us a little of your thought process, what you're considering when you're evaluating investing in a startup.
Yeah, I think there's a number of things that people consider, but I think it's important to understand, for the company to understand the roles of different kinds of investors and how those investors think. So sometimes, we're busy with things, or we really don't spend a lot of time on this. So there's, venture capital investors, there's corporate strategics, sometimes there's angel investors, individuals, sometimes funds that really aren't venture capital funds that invest in a lot of things. And all of those constituencies are looking for slightly different things. And they also have different competencies. So I think from an investor standpoint, you're ultimately interested in risk and reward, right? And more so on the professional side. And sometimes when you get to individuals and angel groups, there may be other motivations. But I think from the standpoint of an investor, if you have a strong angel group or a strong company behind you, one of the things I think about is, can I actually diligence this investment? Do I have the right people on my team to actually evaluate this? So and from an investor standpoint, you see all kinds of cool things, but can your team really evaluate the company? And you have to be fairly honest, because if you put a big team on something and you don't have the right skills, you're really kind of just wasting everyone's time. So I think that's an important consideration for investors that's somewhat overlooked. I think when you start looking at the companies, though, there's a couple of things. And, when I was at 3M, we even had these things. First of all, is it a real business, or can it become a real business? And are the people credible and telling the truth? Because, in investments, you have all kinds of folks. They may not be intentionally not telling the truth, but they may be exceeding optimistic. They haven't done their homework. They don't have the right skills. These sorts of things. And then what does the investor do? I mean, what is the investor all about? I mean, how much money are you typically willing to invest? What stage are you at? You know, and to really have a match with what your focus is with certain companies. So, I mean, you want to be well matched on check size. You want to be well matched on a lot of things. Again, otherwise you're just wasting people's time. But I mean, you're looking for strong culture. You know, you think there's a culture of execution, that the team, either as individuals or a collective team, is high performing, preferably the team. You know, those sorts of things. Obviously, you're looking at the exit potential. I think, you know, having experience in corporate development, I would say most investors typically are way off, most companies are way off base when they pitch to investors what the exit is going to be. They typically, you know, don't have a full picture. Usually the investor is better equipped to evaluate the exit for a variety of reasons. You know, have access to databases and data and their sort of own network. So really understanding whether the company can transact, I think, is very important and is sometimes overlooked. Again, when you get into certain classes of investors, so like a corporate venture fund maybe is less interested in whether the company can transact. But, you know, VCs and angels are certainly interested in whether the company can transact. But the ability of those two groups to actually evaluate what the transaction might be differs. So I try to spend a lot of time, you know, looking at whether the company really can transact. And if I don't really know the space, it's sometimes very hard to assess that. But typically, startups don't know very much about strategic, the other side of the table. I know Cynthia will talk about that. So we try to usually spend extra time on that. So those are some of the things we're looking at. But I wouldn't say it's a team. You know, some people say we just look at the team. We just look at this. Really looking at the forecast and financials, I spend a lot of time on in diligence. And again, I think, you know, VCs, corporate venture groups, these people are very well equipped to analyze financials in many different dimensions. Again, when you get into angel groups and individuals, sometimes there's a lot of effort spent on non-financial analysis, maybe a lot on product market fit. So again, different investor constituencies look at these problems maybe a bit differently.
So Brian, let me take a minute just to highlight some of the things that John just said, because he spoke from the aspect of the investor, but really entrepreneurs, listen to what John just said. Do your homework on who you're talking to. Understand what kind of investor they are. And you could look all this up. All this is good public information. If you are a biotech company dealing with viral vectors and mRNA and mitochondrial diseases, and you look at the website and it says, we're a company that invests in medical devices and digital apps, don't waste your time and don't waste their time. Find somebody who's well matched to what you're doing and to the stage that you're at. And you can find that out by doing your homework. So, John, you are spot on. Entrepreneurs, look at who you're talking to. And before you go pitch to them, know who everyone is in the room. Go to LinkedIn, find out who they are. So when you give your talk, you know exactly who you're speaking to.
And maybe just to take that one level down further, you know, so if you get into life sciences or even biotech, well, even within biotech, there's, I know this isn't really my area, but there's all sorts of things. There's therapeutics, you know, which most people say. Then there's research tools, you know, and machinery and, you know, stuff that plugs into the wall and, you know, software and sort of reagents. You know, these are all different businesses. Sometimes people, you know, invest in therapeutics and they know that very, very well. And then they're really not going to invest in, I don't want to call it machinery, but, you know, laboratory equipment. So even within a general area, there are distinct competencies, and who you're talking to within the firm may have a focus area. The firm may do several things, but if you're talking to the software person or whatever, hopefully you're pitching software. Otherwise, you're talking to the wrong person. You have to find another person in the firm. And these things are typically overlooked. They focus on, check size, geography, but really, what does the investor do? Can they diligence your deal? Can they understand what you're actually talking about? Is very important. Again, otherwise, you're just burning valuable resource time.
Cynthia, one of the key points that John brought up that a lot of investors focus on is the team. Is there anything that you can tell us what certain aspects of the team that you like to evaluate?
Yeah, absolutely. I just want to add one thing to what both John and Jeff said, but take it one step further. It's really important to capture how you differentiate from your competitors. So you want to attract by knowing the market. And so just to go back to your question, because that was something that's really, really important too, especially for us as, strategic investors. It's important that we can trust our team, and our team is capable of, not only an exit, yeah, that's great, but we're usually looking at, are they capable of executing what they say they can execute? Do they have the tools to actually achieve their goals and their milestones? Because oftentimes, there's these lofty goals and these, kind of exciting potential avenues that these different, companies can go down, but are they actually capable of achieving that? And we're seeing that a lot right now with AI and ML, where there's these, this is what we want to do, or this is what we plan to do, but is it achievable with the team that you're currently raising money behind? So can they achieve what they say they can achieve? And are they capable of meeting their timelines and milestones? And then in addition to that, how is their scientific advisory board, their SAB? Or do they have, experienced scientists, experienced clinicians behind their team? If they're a younger team, do they have these additional support mechanisms that can help to advise them and to guide them in the right directions, instead of just kind of shooting off the hip? So not only are we looking at the team and the team's capabilities, but also the support from the board and the SAB.
And maybe just
and Cynthia, can I ask, how does Amgen operate? Are you agnostic as to the type of venture that you would engage and support financially, or does it have to dovetail with the strategic objectives of the parent company?
Sure. So we do both. So Amgen Ventures does dabble in white space. And of course, strategies always ebbs and flows, right? So what we might have been investing in 5 years ago, say we have a handful of portfolio companies in a certain area, let's use neuroscience as an example. We might not be pursuing that particular area currently in R&D, but we have those portfolio companies because we were in the past. Another example would be, environmental or biodefense, things of that nature that would be considered white space. Obviously, Amgen is, biotech pharma, very much biologics focused. And so we're not doing anything with biodefense in-house, but we could use that as an investment mechanism in our white space investments. So we do both.
And then on the founders and, it may be a different aspect of people. When I was doing straight merger and acquisition, you run into a lot of creative representation of facts, right? So if you're a company, there's a couple of things that are red flags that no one is going to challenge you on in public, but people will talk about. If you say members of your team have been involved in an exit, that's going to be researched. So if the person really was involved in some company that exited and really didn't have a lead role or a C role, that'll be found out, because that's fairly easy to research. And then the other thing that's easy to research is advisors that really aren't involved in the company. So there's, it's fairly easy to get a bunch of interesting university logos of people that are very, very busy that probably aren't devoting a lot of time to your venture. And it's relatively easy to contact those people and see if they're really involved in the company. And that type of diligence does happen. So as far as, on the company side, don't stretch the truth. if you've been in an exit or you have great advisors, promote them. But if you have people that have been on the periphery of an exit or really don't have time to give you advice, don't advance them as key members of your team, because that'll be found out, and that is kind of a red flag that'll be discussed when you're not present.
I'd say one characteristic we commonly hear in such discussions is the coachability of the team, which I think really can be demonstrated through the due diligence process. Do you have any experience with that, Cynthia, about how you really start to see, are they listening to your input?
Yeah, absolutely. There's, Amgen Ventures has, for our small and mighty team, we have kind of a large portfolio. So there's always going to be different personality types and different dynamics that go into that. But, initial conversations, both pre-confidential and, confidential discussions, you can kind of get a read on how open people are about, what's not only going on with their science, once we're in confidential discussions, discussing the science in detail and how open and transparent they are is very important, because that kind of contributes in an adjacent way to their ability to be coached. Coachability just means, active listening, taking the information in, determining what's best for you and applying it or altering that, but constantly staying in communication, right? I have come across people in my current job, as well as in prior experiences, that lacked the characteristics of coachability. And not only do they make difficult team members for the company and in the team, but it also makes it difficult to work with them. And when you're trying to ask people for money and guidance and support, because when you're talking to investors, it's not just about getting the money in your pocket. It's also about, especially from a strategic standpoint, how can this strategic investor support the advancement of my business and my company and my technology? And so if you're coming to a strategic investor looking for funds, you're also coming to them looking for a relationship and guidance. And if you're not willing to be guided and to build that relationship, then there's going to be kind of a turbulent situation, and then it's pointless to have a strategic investor, if you're not willing to take the guidance of the people with the experience.
I think there are tons of more factors in this evaluation that we'll hit on as we get to some of the other questions, but maybe just to switch it up a little bit, I want to ask Azad, how do we start thinking about what kind of funds am I raising? This panel's on pre-seed, seed, and Series A. So where do I see myself fitting in that picture? Even if I figured out I need to raise $3 million, I don't know what kind of round this is and how do I execute it?
Yeah, no, that's a great question, Brian. And that's a question that comes up, at an early stage, especially for an early stage company trying to raise funds, first time, or a company that has raised funds and is trying to bridge to the next round. These questions arise more often at that stage. If the Series A, if the company is at the Series A stage, the company has already done some seed funds, and the company is talking to the Series A investors, then it's kind of set that the investors at that stage are looking to do equity financings and not so much interested in convertible notes or safes or whatever other convertible instruments are being used at an earlier stage. But it kind of goes back to the point that Jeff was making earlier, and John was also making earlier, is you need to know your. There are if you're talking to a venture fund and it's a late stage venture fund, that's not, those guys are not going to, they may like the technology, they may like the team, but they are not a real right fit for the company. And so to know the audience is really important, not only from them, but also to figure out if, what terms are these investors going to expect. There are, at an early stage, pre-Series A, pre-seed, and family round, or if it's an angel round, safes and convertible notes are more often used than not. There are some angel groups that are more keen on doing than safes, but safes these days are becoming more and more acceptable, I would say, in the early stages, in the first round of financings. And as you progress, depending on how much you're trying to raise, if an investor were to say, if you're trying to raise a few $1 million, and even if it's your first round of financing, and the lead investor were to say, hey, I'm not interested in a safe or convertible note, I only do equity financing, then yes, you can. There are equity financings that can be done at fairly efficiently, and less time consuming and in a fairly less expensive manner. So to answer your question, depending on who you're talking to, that investor is how much you're raising and what is the investor's expectation, I think really decides whether the company, what instruments the company should be looking at. But the options available are safes, convertible notes, or seed financings.
Probably we could do a whole webinar, but can you give us a brief description of what is a safe convertible note and equity and the differences in?
So safe is essentially an agreement. It's the name. It's a simple agreement for future equity. You're essentially entering into an agreement that as and when I do my price round, I will give you investor preferred shares, preferred stock. You build in some protections for the early stage investors by saying, hey, I will give you a discount, or your conversion price will be capped. So those are the protections that the investors seek, because they're taking a bigger risk than the later stage investors. So convertible note is a form, I would say that it's a debt form of a safe. First of all, it's a debt, not a safe. So it shows up as so the investors, in addition to other contractual rights they may get, they are lenders, they're creditors, so they get some protections as credit. Is an interest. This as opposed to a safe, the convertible note will have. There is a maturity date concept. If the note doesn't convert prior to the maturity date, then you have to think about what are the ramifications for the company. But otherwise, from the investor's perspective, the terms are pretty much this. The terms are pretty much same in terms of investor protections. You build in a cap and you build in a discount to the next round. And financing is equity financing. You're basically taking your money and selling shares, issuing preferred stock. So the investors then actually become stockholders in the company, as opposed to being a creditor or as opposed to just having a safe.
John, can you tell us a little from the investor's perspective, of potential preferences they might have on a safe convertible note or equity round?
Yeah, I mean, it really depends on the type of company and what the stage is, and what type of investors you're really trying to attract. And I think that was covered in various of the other comments. But if you're looking for just money, there's a variety of these instruments, right? And some groups, particularly angel groups, really are not interested in safes, or whatever. So, if you're pitching to those groups, groups that typically are not located in California, you are going to get some pushback on that. I've gotten pushback on stuff I was trying to get funded. So, I mean, some of those instruments, there's investor perceptions. But I think this goes back to the point of, what type of investors are you looking for? If you're just looking for money, a financial investor, it's really all about who's going to give you the best terms, right? If you're looking for something else other than money, either positioning, a brand to be associated with, if you're looking for, a strategic investor, it's not just all about the instrument. So there's other things that come into consideration. So from a company standpoint, what you're really are you looking for a lead investor, right? So then you have to look for somebody that maybe has a good instrument, but also has other skills. So I think from the company standpoint, there's various ways to look at this. I think from the investor standpoint, certain investors are just comfortable with certain types of instruments. Are comfortable with convertible notes, comfortable with preferred equity. And, those people are hard to move. As you get into more professional investors, then I think it was covered earlier, they're less likely to be looking at safes or, other sorts of bridge, creative small financing. They're looking for, a larger, commitment. And then I think the other thing is sort of a two-way thing. Are you looking for something more than a passive relationship? So are you just looking for money and a lead investor, or do you want like board members or expertise? All this has to be factored into like what the whole package is. So if a company is just looking for money or a lead investor, I think that's a relatively easy thing. If a company needs specific board skills or something like that, or synergies with other portfolio companies, then I think obviously there's more to the decision making than just terms. So this can become a fairly complex problem, but again, it depends on what you're looking for.
So
And that makes the job of the
entrepreneur.
entrepreneur
It makes the job of the entrepreneur challenging.
much more challenging, because not only are you pitching for an investment, but now you're saying, not only do I want an investor, but I want a specific kind of investor. So you're narrowing the universe of potential people that you want to invest in your company. And sometimes that's just daunting.
And then, as you get into things like corporate investment or, corporate ventures or something like that, you have to look at cultural fit and geographics and, all sorts of other things. Sometimes people are willing to take money from anywhere and really don't have a lot of international business experience. So there's maybe willingness to invest to gain access to interesting US technologies. But on the investor to company, it's just a very different process, because they're maybe expecting a US company, when in reality ways companies work in other parts of the world, there's slightly different nuances and different laws, so it can get fairly complex. But really understanding what your goals are as a company, and really what your goals are as an investor. As an investor, do you really want to get involved in boards? Do you really want to commit people to things? Do you really want to put people in observer roles? And these things detract from other stuff these folks can be doing. So there's, an aspect of resource management. So this can become a fairly multidimensional consideration on both sides.
I think the board seat's a really interesting topic. I would like to see if Jeff can maybe add some of his experience of, have you had an investor added as a board member, and tell us a little bit about that process.
So with each of the either seed, pre-seed, series A, B, C, there may be an opportunity to appoint a board seat. Usually with the pre-seed and seed, you usually don't, because those are usually smaller rounds. But certainly from series A on, if you have an investor that's putting a sizable portion of that series into your company, they may demand a board seat. And you have to then say, is that the guy I want to sit on my board? Does that person fulfill the requirements that I really need as a board member? Or will that person be a rabble rouser? Will that person be an obstructionist? Will that person cause drama and friction amongst the board members? In which case, that becomes a really difficult decision. So yes, in our Series A, we had one of the original founders of BioFactura as a board member. And in our Series B, we had one of the institutional investors, the University of Vermont Health Venture Fund, which is a fund from a 8-hospital system in New York and Vermont, come in as a board member. And luckily, the board members understand each other, have different expertise, get along, and move the company forward. It doesn't always happen. So be very mindful and careful of who you choose and how you choose them.
Cynthia, anything you can tell us about Amgen's practice of taking board seats?
Yeah, we are typically in a position for a potential board observer seat. I think, being a public company, Amgen being a public company and whatnot, there's a lot of complications that come with an actual board seat. So we usually it's usually built in that we do a board observer seat. And really the idea there is that when we're strategically investing in various technologies or therapeutics, that we want to know what's happening with the company. We want to know what advancements they're making. We want to know if, that's something that we can integrate into our pipeline or that we can, contribute to them somehow. So there's very much it's the purpose is to for knowledge really, and to support the companies, but we don't take a voting seat.
Azad, can you tell us a little bit about how the responsibilities and privileges are similar and different between a regular board seat versus a board observer?
A board member has fiduciary duties to the company. So, the duty of loyalty, the duty of good faith. An observer is more like a contractual right that the investors get to appoint someone to attend the board meetings, to participate in the board meetings, to get informed about what's happening in the board meetings. So, from a company's perspective, and again, some of these terms are pretty standard that you see in financing documents. If an investor is appointing a board observer, then you try to build in provisions where you have confidentiality obligations. You have the right to, a right to request the observer to not be able to participate in certain discussions, which are where there may be conflict of interest, where there's a attorney-client privilege. So you build in those protections from the company's perspective, where whereas with a board member you don't have to think about those things. Like I said, board members are fiduciary, have fiduciary obligations to the company.
And from a strategic perspective as well, just to piggyback on that, we also build in safety nets for ourselves because conflict of interest is a big concern. We don't want to put ourselves at risk. We don't want to put our science at risk, and we don't want to put our investments at the companies that we're investing in at risk. So there's a lot of safety nets and silos going on to make sure that any board observers or people that are contributing, scientifically versus on the business side are very much, protected both on our end and the company that we're investing in. That's a really good point. It's important to think about conflict of interest when you're approaching anybody in that respect.
Yeah, I just had a couple of quick things to add. One is maybe even just related to the previous comment. So, one war story I have, which I'll sanitize a little, was I was on the board of a small company a minority investment that came with an acquisition. So I sort of inherited this thing, and it's somewhat unusual. And there was some issues in the company, particularly in manufacturing, which resulted in destruction of part of the facility. So company, there was an explosion and all this kind of thing. So I got a phone call from one. I was in a corporate environment. I got a phone call from the attorney reminding me that my responsibility was to act not as a board member, but not as the multinational role, meaning you're likely to be sued potentially as an individual. And that's very different than having an advisor or observer role. You could potentially get into some fairly messy stuff. I would say that was one of the least pleasant things I had to deal with in my corporate career. I think another thing from the company side, particularly when you get into angel groups and other sorts of non-corporate, non-professional investors, you really want to get someone that knows what it means to be a board member, that has some experience doing that. You don't really want to be, there's enough stuff going on in a startup that's difficult already. Providing on-the-job training to new board members, probably is not one of the things you want to get involved in.
So John, I'm laughing a little bit because most of the times the entrepreneur themselves are the ones that have the least amount of training in
Right,
corporate
right.
governance. So what I'll say to the entrepreneurs out there is take the time, learn about corporate governance, understand what it means to run a board, look up specifically in your sector, what are the appropriate guidelines for having a board and running the board, and what to watch out for and what to be notable in terms of red flags. Talk to your attorneys. Make sure that they allow you to understand what are the legal ramifications of who you choose to put on that board. So it's one of the things that as a life science entrepreneur, you just don't think that you have time to do because you have so many other things to do. Raising money, good technology, managing your lab, getting your milestones done. Governance really gets put to the side, but until it doesn't. So take the time when you can, learn about it, understand it, get a good attorney who could explain it to you, and make sure that you don't make the mistakes that other people have made before you.
Mhm.
So I think now that we've gone through the startups, figured out how much they need to raise and who they want to raise it from, I think what we should explore a little bit is how they find and reach out to those specific type of investors. So maybe I think Cynthia might have the clearest pipeline. So maybe you can start by telling us how should people find you to explore investing?
Yeah, so, there's, we get a lot of cold outreach. We also get, so let me start from the most efficient way is to have, a soft introduction. If you have somebody in your network that knows, somebody at an investment group or a strategic investor that you want to get in contact with, it's best to have, a soft introduction. I think this was touched on, or it was touched on earlier at the beginning of the discussion, which is really understanding who you're approaching and if it's the appropriate person to approach. And that is just done through, basic research. And, as far as like strategics and larger, pharma VC groups, you can go through their online portals, which is usually kind of the bottom of where, we're really evaluating. And then just cold outreach. So usually people are, available on LinkedIn or information is posted online. Amgen is all outreach goes to a couple specific people. And for Amgen Ventures, it is me. So, any outreach that goes to anybody in the company that has to do with strategic investing or has to do with investment from Amgen Ventures specifically ends up at me. So you could really reach out to anybody within the company or within corporate BD itself, and it will end up on my desk. So there's that piece of it. But taking a step back, building relationships and building community and getting feedback from people and understanding who the proper investor is, and then reaching out to them, I think either through, common ways of email and that kind of thing. But you definitely want to do your research. I think that one of the most important things is that understanding who you're approaching and tailoring your communication to those people. And so that would really be, the suggestion is definitely to try to find a way to reach out to an investor in a more personal way, because then it's, handled with more care. And then from there going, kind of down the totem pole of going through, people that or going through, corporate websites and things of that nature.
So one thing you mentioned was the soft introduction. I've certainly met some attorneys who help with soft introductions, when they're doing a lot of startups. Is that something that you do?
We find more that it comes in through either more of like banking consulting type of groups or life sciences consulting. We are open to outreach from anyone, and regardless of the avenue that it comes through, if it comes through a lawyer or if it comes through a consultant. Typically we're approached in that way. I would say I can't recall anything off the top of my head where I've been actively approached by a lawyer that wasn't in a consulting situation. So it'd be more of a consultant, I would say.
Is that any comment?
I think Cynthia is absolutely right. We are part of, as lawyers, especially law firms that work with emerging growth companies, startups. We are part of the ecosystem. We are out there networking as much as the entrepreneurs are, as much as the investors are. The investors are also looking for good deals, the deal flow. So we get to make connections, and we get to meet investors, we get to meet entrepreneurs, and yes, we can make introductions, we can make soft introductions, but at the end of the day, it's the investor's decision whether they want to invest or not. Obviously, we are not investment bankers, and so we don't charge a fee for our introductions. But yeah, this question gets asked by a lot of entrepreneurs. Are you guys? Can you make introductions? Absolutely, we can make introductions to the extent we with the right investors. We are happy to make those introductions, but whether the investor invests or not, it really depends on the investor.
Jeff, what are some of the ways that you've gotten those soft introductions?
So let me just say that the establishing communication and engagement with investors and strategic partners is an exercise in kissing frogs. And over the last 10 years that I've been in the biotech business, I've kissed tens of thousands of frogs. Very few of them become princes. So one of the things that entrepreneurs have to learn is humility. They don't care what your credentials are. They don't care what school you went to. They don't care that you were first or last in your class. It's like the senator who's on an airplane, and the senator is not sitting down when the plane is on the runway, and the flight attendant is saying, "Please, everybody sit down." And the guy stands up and looks at her, gets right in her face and says, "Miss, do you know who I am?" And she gets on the microphone and says, "Excuse me, we have somebody here in first class that doesn't know who he is. Can you please help him?" So nobody cares who you are until you get to speak and give your talk and talk your pitch and establish the fact that you are differentiated from 1,000 other companies that are out there looking for funds. So the ways to look for them are the typical ways is friends and family first. After going to friends and family, you ask those friends to ask other friends and other family. That can get you through the pre-seed and seed stages. When you get to the Series A, depending on the type of company you are, if you're a digital app, you won't need as much money. If you're a med tech, you'll need a little more. If you're a medical, if you're a biopharma company, you'll need a lot more. So depending on the kind of company and the amount that you're trying to get will depend on who you target, whether it's going to be angel groups, family offices, strategic venture partners, or venture capital or private equity. Those are your family of basket of potential investors. You can find them at places like Bio. I was just at Bio in Boston. Bio is more for strategic partnerships than it is for investors per se, but other ones like JP Morgan, Biotech Showcase, LSX Congress are all places where there's a lot of frog kissing going on.
I'd like to point out that one of the ways to build this traction is through participation in very selective pitch events like this one. That's something you can get in front of investors and start to get some good, word of mouth from them. They might introduce to some of their friends that they co-invest with, but also that many early stage companies are participating in accelerators and incubators, and there are certainly a lot of resources there to make connections to investors. But I want to throw the ball to John, who actually has experience consulting the startups in this area, and also share a follow-up question we've received about whether soft introductions should come with a finder's fee if it turns into an investment.
Well, maybe just to take one step back, when you're in a firm, and I had responsibility for, several divisions when I was at 3M, looking at all different industries. When you're on the other side of this, you're getting hundreds of things a year, right? So a soft introduction there's many, a soft introduction, a hard introduction, an introduction from an investment banker. All these things go into one big list, right? Or, someone's running an auction or, whatever. So soft introduction is great if it leads to anything, but there's no guarantee it's going to lead to anything. This whole thing about a fee, I don't know. I mean, you run into things that, you could run into situations where more than one person claimed they made the introduction, and then you have, various people claiming they're entitled to something. So yeah, I typically stay away from stuff like that. But I'm at the stage of life where I'm just kind of doing what I want to do, and whether I'm getting compensated for it or not doesn't really matter so much. And there's compensation somewhere, but you don't, it's less of an issue. I don't know. I'd be for an early stage firm. I think I'd be very suspicious about soft introduction for a fee on either side. And good companies, good investment groups don't need people finding them stuff. They'll find it, whatever. So I think soft introductions are very good. I think, as all of us probably make soft introductions regularly and are not getting compensated for it, or at least not directly. I think those things are fine. But, you have to keep in mind the best companies, the best investment groups, the best angel groups are seeing hundreds of these things. And, for whatever reason, you may not be in vogue that day. Everything can go right. You could have the right introduction, the best deck, but there's some better deal or some other crisis or something going on somewhere. So it's a bit of a numbers game. You need many of these things going. So just getting a soft introduction to XYZ company is fine, but that is not sufficient to close anything,
So I think let's move a little.
Let me,
Yeah.
Brian, just to, on the finders, the fee for introductions or fee for raising capital, there are some securities law issues as well, which play an important role. And, a lot of the entrepreneurs, first of all, you can success fee only to someone who has a broker-dealer license.
But
And
you see various creative ways around that. So if somebody's arranging, networking events and all this kind of thing that really isn't selling securities, but they have buyers and sellers in one room and somehow are extracting value out of that group, I don't know, that's a red flag to me.
Exactly. Yeah. So you can set up, there are creative ways of setting it up, but success fee is something that the SEC frowns upon. The Securities Exchange Commission frowns upon that, particularly if you don't have a broker-dealer license. And a lot of entrepreneurs will they come. My own clients, they'll put this question to me: "Hey, I met this guy. He's telling me he can help me raise capital. I need to pay him. If he raises, if he helps me raise capital, I pay him 5% or X%." And then the first question you ask is, does he have a broker-dealer license? And then most of the times they don't.
Yeah.
And that's a big red flag. And I always advise my clients not to try and get creative around. If you really want to pay someone, then might as well go talk to an investment bank.
Right. Or, an accelerator or some other institution that's not trying to creatively navigate things. So the other thing is, I think maybe just from a more managerial perspective, I remember a situation where somebody wanted me to help in some situation. It was one of these weird things that really wasn't put together right, but it came down to the CEO just didn't want to do fundraising. And it's like, well, that's that person's job, right? I mean, they're just going to, if they don't want to do that, then they're not going to want to do something else too, probably. And, it's just, there's just a lot of red flags that it can arise in these situations, but it does, it helps you ferret out values of people.
So I want to move to the next step where, we've made the connection with an investor and we're actually, going through the pitching and diligence process. So why don't we talk a little bit about, what does it take to have an impactful, pitch, and then what's the time, what does this process take in terms of time that I should plan for when I'm on the startup side?
Well, it really again, it depends on the type of technology that you have and how long it takes you to put that deck together and how long it takes you to tell the story. Remember that every time you have the opportunity, you are telling a story. And those who are good storytellers are those that are good pitchers of their, and those that are not good storytellers leave the audience flat. So you have to be able to engage the people you're talking to with a compelling story. First delineating, here's the problem. Here is the problem. And here is our solution. Then you can get into the details and what makes you different and why your technology is better and how you're going to look at the competitive landscape and how much funds you are going to need, because you always think you need more than the investor thinks that you need. So you're trying to convince them you need this amount because in order to get to the next milestone, which is an inflection point to raise further funds at a higher valuation, which is good for that initial investor, here's the story. So storytelling is an important skill. I encourage every entrepreneur to learn it well.
And that the story be based on truth and actual facts.
Totally.
Not just, and I think Cynthia will have probably some comments on this as well. Coming from an environment where some of us spend a lot of time putting together and evaluating PowerPoint decks, what I usually try to tell my team, if a deck isn't perfect, don't go forward. And I spend a lot of time on the deck because I had roles like that where you had to pitch stuff, internally, or you're receiving stuff. Every part of the deck has to be strong. I mean, if you watch the basketball, to get into sports, if you watch the basketball game, right, at that level, those teams have to do everything correctly. They just don't shoot the ball. Right, they have to do everything. And in the deck, obviously, for this type of highly technical product, you have to have product market fit, you have to have differentiation. I think we talked about that before, but you have to have a believable financial model. You have to have an exit strategy that's actually based on facts, not hope. Most of that, teams don't do as well on that. They pick, a couple of situations that maybe exaggerate where they really are. But I really lean on my teams, and accelerators and stuff like that on the deck. The PowerPoint deck isn't perfect. I usually really badger them. And maybe that's an artifact of the environment I came from. But again, on the other side of this, the better investors are seeing many of these things daily. The deck has to be perfect. And that's how you communicate. If you're in a larger organization that has investment committees and all that type of thing, you're communicating through these decks. So what you say in the story is very, very important, but sometimes stuff gets passed around without the entrepreneur being there too. So the deck has to be perfect. And people in private will say things that they won't say in public when they're evaluating, stuff.
Cynthia, can you tell us what kind of materials you require, and then also take us through the timeline from when you get those materials through diligence to execution?
Sure. So I'm just going to take a step back really quick and just add on to what John and Jeff were saying. One of the also most important pieces that you want to consider is if somebody is reading this deck and they're not trained in your field or they're not, they don't have you or somebody from your team in front of them, can they still ascertain all of the information and pieces and elements of your story that you're trying to get across without the scientific or medical training, without a team member being in front of you? So that is a really, really important piece to communicating. I was sitting in a seminar not too long ago, and it was discussing different funding mechanisms, and it was an SBIR webinar. And essentially, it was somebody on the panel was complaining that they weren't approved because they'd gone into so much detail about their science that the reviewers asked them to take a step back and talk about the science in a less technical way. And that was a criticism they received on their feedback from the NIH. And one of the things you want to consider, especially if there's, we're here at a life sciences panel, right? So everybody in the room has some sort of, contribution to science, or is working on a scientific project or life sciences project. So make sure that your science and your data are, understandable and can be translated to a non-scientist. So that's a really important piece. So going back to what our process is, and from beginning to end, it really varies. It varies on the technology. It varies on our current strategy. So for instance, if if it is a company that's working on quantum, right, that's probably going to take a little bit longer, because we're going to look at all the different applications and how we can apply the platforms into not only potentially our R&D, but how we could potentially partner pilot programs, things of that nature. Whereas if we're just looking at a one-off or a two-off pipeline, review, then we can really look and say, okay, are these molecules, do they complement anything in our current portfolio? Do they complement what we have going on in our own internal pipeline? Are they differentiated? Are they, better than standard of care? All these really basic questions. Are they in strategy? So those kind of processes usually, can take 2 weeks to kind of say, yeah, we're going to move to confidential discussions. And it also very much depends if they're international or not, because, that creates differences with CDAs and meeting times and all of that. So, there's these other external factors, but in general, to get an initial yes or no, it's, 4 weeks or less. And then the yes is contingent on, well, let's get into confidential discussions. And now, getting into a data room and really, granularly looking at things, and whether or not the financials make sense. And so there's a couple of different factors. But from initial outreach to saying, yes, let's move to the next step of diligence, or no, we're not interested, is 4 weeks or less.
And what kind of
maybe
do you have? Sorry, go ahead, John.
To the companies listening, sometimes there's a tendency to dismiss larger organizations as bureaucratic, because stuff takes a long time and they don't really understand what's going on behind the curtain. I'd not rush to judgment on those terms. Large organizations do a lot of things very, very well that are not transparent to the prospective portfolio company. So, if you don't hear something, or things are going too slowly, but they're moving in a positive vector, you should be satisfied with that, in my opinion.
And one thing that I wanted to add about the deck is, entrepreneurs, be the masters of your deck. In other words, you may have other people adding things to your deck just to make it more complete and more substantive. But if there's something in there about design of experiment, and you have no clue what design of experiment really means, prepare to be questioned by the investors on everything in your deck, and be prepared to answer them completely, honestly, and correctly.
I see JJ has appeared.
Any questions from the attendees? We had, I guess, a couple of questions that were already answered. Brian, are we almost done?
Yeah, I think we've covered quite a lot of topics. It's great to hear all these stories and share the experience that we have from the range of investors and entrepreneurs here and advisors. I think we have a couple of minutes left, and we're fortunate to have Cynthia here from the venture investing perspective. So maybe you can tell us a little about what are the different deal structures. I think we mentioned very briefly, but if you can tell us a little bit about that before we go, that'd be great.
Sure. So I mentioned previously before that strategic investors, we are a vessel for financial support, but we're also a vessel for, support of growth of the business and, everything from whatever you're going through the different stages. So initially, we will invest in early stage companies if we see the potential in the company and the potential in the technology and potential integration into us or getting acquired by somebody else. But when we're going into later stage investments, so let's later stage, meaning like after seed or, series A-ish, we're really looking at, how can we support the growth there? There's not always a pilot program or a partnership that's going to develop from an investment. So it's really important to have the understanding that just because you have a strategic investor, it doesn't mean that you're now a partnership, because your strategic investor will support you and advise you and keep you moving along and keep you accountable in different ways. But they're not necessarily saying, oh, well, Amgen's investing in you, Amgen Ventures is investing in you, so now we're going to develop a partnership with R&D. That's a totally separate entity. Does it open the door to that? But it doesn't make it a through and through. It's not necessarily going to happen. So there are opportunities for different types of partnerships, whether it's a pilot program in R&D or a later stage commercial marketing, those kind of things. In addition to that, there's a lot of support just, from experience and education wise. We can, if there's a board observer seat or some sort of other type of relationship, there's a lot of advice that can be given, and that's really kind of tailored and one-off, and depending on, the needs of the company, obviously, because we as investors want the company to be successful, so our investment is successful, right? And so there's a lot of support in that way. So there's partnerships, then there's also deals that can do with commercial and marketing, and then there's just the straight investment.
Thank you very much. I think we've got a lot of great advice today for the entrepreneurs. Hopefully they'll avoid some pitfalls that others have fallen in before, and be able to reach for some opportunities. Thank you all for participating. Thank you, JJ, and thank you to Quan Nguyen for helping to organize this panel. It's been a pleasure to take part.
Thank you all very much. Brian, you're always been great. I really appreciate your participation. And I know Quan is on the other side. He's listening to us. So Quan has been tremendous in making this panel and this event happen. So much appreciated to Quan. Cynthia, thank you. John, thank you very much. Jeffrey and Azad, thank you all for your knowledge, experience, and wisdom here. I think, everything you said here is so important. If the listeners just get one or two things out of it and really concentrate on this, it's really great. Especially, Jeffrey said few things like that, like people don't pay attention to it, like be a good storyteller, right? That's like really huge. You don't do that, you're probably not going to get people listening to you. So it's very important. Practice. I keep telling everybody to practice for Thursday. So please do. Thank you all very much.
Thank you.
Thank you. Good luck, everyone.
Bye-bye. And for the attendees, there's another